Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Today's video is going to be a fun one in that I'm going to go through a experiment that I've been conducting over the last year. We all know the mantra of reward versus risk, and you should always have a 1.5 to 1 or a 2 to 1 or a 3 to 1 reward to risk ratio. But that isn't always what I found to be accurate in the market. So I set out to do an experiment to actually try to prove whether or not that was the best way to make a profit. I started with the premise of a 1 to 1 reward to risk ratio, that the market can move either direction with a probability of 50% of the time, following through with a lot of the more advanced traders, hedge funds, mathematical experts, and so on. I felt this was a good starting point and it represented the common thinking process and teachings of professional trading institutions. So with a 1 to 1 reward to risk ratio yielding a 50% probability of the market going in either direction, that means a reward to risk ratio of 2 to 1 means you have a 25% chance of making a profit and a 75% chance of hitting your stop loss. Now, we know from previous experiments that the market will always hit smaller targets before larger targets. So it's easier to move 10 pips than it is to move 20 pips. The 20 pip challenge that I featured on this channel covered that very extensively and just how bad it turned out in a real market situation. So with that premise, I decided to try a different approach for these experiments. What if I did a bad reward to risk ratio? What would the results be? Would I lose money drastically? Would I wipe the account out? Those are the kind of questions that this experiment answered. And for the purposes of my experiment, every time I hit a sell signal, I opened a short. Now this led me to a situation where I am able to test repeatedly in a way that gave me a consistent level of results. For the purposes of my experiment, I used the Australian dollar US dollar forex pair for its cyclical nature. The one thing that must be emphasized when looking at, quote, a bad reward to risk ratio is that you need to understand your market. Market research is absolutely critical. So I chose this market as my test bed for several dozen tests and different changes over the course of the year. What I found that worked well was looking at the market, finding out what the worst case scenario of the market was, figuring out the position size, and figuring out just what the market actually did or moved. So with all the research out of the way and the numbers conducted, what I found for this market in its 21-year history, that a 10 pip take profit and a 407 pip stop loss would be a good testing metric. And we are actually going to get into the results both of my live trading account and my demo account. Yes, I actually traded real money with this strategy. And those are shown here. I took a total of 633 trades. I ended up with 0 stop losses, and I made an $89 profit. It's important to keep in mind that I kept my position sizes extremely small deliberately. On my real money account, I made 267 trades with 0 stop losses, and I made an $11 profit. Not a lot of profit, but the goal of this experiment wasn't about profit, but rather, was this insanely backwards or bad reward to risk ratio actually sustainable? Because one stop loss could decimate all of my profits. And that was the whole point of actually trying to determine whether or not this technique was viable. So let's look at the actual technique. I've talked about this strategy before. The 1747 crossover with the 197 momentum. It's a classic 20/50/200 and it just works. But remember, we're using automated trading, not human discretion, not a seasoned individual with a great deal of insight to the market, but a machine that can never match the capability or aptitude of a real human. So I wanted to keep this strategy realistically simple for the machine. Every selling point opened a short. At the highest point of the strategy, I think it was around 150 open trades simultaneously. Now, because I had very small position sizes, I could really capitalize on not worrying about my budget being blown up. For example, in my real money account, my position sizes were only 10 units. Not a lot. Profits were very small, but it still proved remarkably well. So let's get to the first charts and actually talk about what really happened in the trading. Let's look at those trades. Okay, let's start with the demo account and the 633 trades. Yes, you are looking at 633 trades. Let's actually zoom in a little bit and see if we can get this blown up some. This is a hyper-aggressive aggregated approach. This is designed to capitalize on probability and statistics. Now, a lot are just simply going to say that this was just pure luck, that if the market had gone against me, it would have destroyed the account. With the exception of being on the right side of a volatility swing when it happens, luck isn't part of the equation. This is mathematics and probability. To say that this profit, $89, is luck only implies that trading is nothing but gambling, and it's not. Proper trading is about math, statistics, probabilities. It's a real science that determines whether or not you are actually going to be able to make money in the market. And by using an aggregated approach with a hyper-aggressive technique, meaning lots of tiny positions that over time can add up realistically well, you are putting probability on your side so that when a stop loss does occur, and it will occur sooner or later, you are guaranteeing that you have a framework in place that will always put you ahead of the stop loss. You will be able to absorb it and continue to make profits because of the probabilities and statistics that are in your favor. Even if I was just to flip a coin or take a random trade anywhere, because of the 10 pip take profit, 407 pip stop loss, I have a probability of hitting my reward target 40 times more than I would a stop loss. That is, at a very minimum, I am likely to take 40 profits back to back versus one stop loss. Now, the market is never that cut and dry, but by putting the numbers on your side with a scientific approach, you are giving yourself the room and the space to make sure the market can provide as much breathing room and profitability as possible before you hit your stop losses. Now, the other thing about this, particularly with what you see here, is this is not a grid trading strategy. This is individual trades, as we can see in the actual chart. Individual trades at various positions within the market based upon where they are with the crossover in relation to the momentum. That is important. Each trade could be a winner or a loser. You just don't know. So by looking at the market, by looking at each trade, the resemblance that it provides as a grid trading system is uncanny. But it just goes to show the mechanical process of formation, of a stepped approach, of the mythology based behind aggregation and how it works in the long term. So now that we see the demo account, let's take a look at the real money account and see how it did. And it was a lot more defensive than the demo account. This one only took 260 plus trades, I think 263, and you can see just how sparse it is. You can see how it held, you can see how it did. A very easy process that when you really figure out what the actual exposure rate was, it really only had about a $340 exposure rate. Now that doesn't sound like a lot, but realistically you're looking at a very good profitability for such small amount actually being invested. And that is the whole point. But the downsides, and yes, there are some downsides to this process. When you're using a hyper-aggressive approach like this that relies purely on aggregation, you're relying on the continual inflow of trades to offset where the market might be over time. If you're using a slower strategy, you need to be more frugal about your position sizes and your entry points, because this is making up the difference by the continual number of profits it makes at such a large level. It may not be suitable in every circumstance. Again, one of the points I made early on in this video, research is absolutely critical. The other thing you need to really take account of is you must make sure you're trading in the direction of the overall market. If you're trading Bitcoin or the S&P 500, then you need to look only in the long direction. This kind of a technique may not work well trying to short an asset like Bitcoin. It's something you need to test, and test carefully. So now let's look at the equity curve. And here we are. We can see just how volatility affected the market and how pricing really made a difference within the process. This one isn't really all that impressive in terms of the quote luck factor. But when we go to the real money account, you can clearly see the one point where luck really made the difference. The one point that could have taken longer or potentially hit a stop loss. This is a real concern. And this is why this particular account only used a 10 unit position size and then scaled it based upon the FIFO regulations. The highest point I had in this was only 135 units. Very small positions kept very low key. That really is the secret to quote a bad reward to risk ratio. You want to put as much of the market on your side as possible, and you want to do so with absolute mathematics. Which brings us to the stop loss. Where did I get 407 pips? That answer comes from looking at the entire 21-year history of the asset. Finding the highest point, finding the lowest point, and then running a month-by-month analysis and tracking the average. The average of 1 month's worth of movements is 407 pips. Mathematics and science will yield the numbers you need for any asset in any market. But you must take the time to do the math and look at it carefully. So with my 470 pip process, we can see that the market has a dramatic approach. And we can see just how many selling positions or buying positions it can make quite easily. So these numbers are not about gambling. They're not wild guesses. They're carefully calculated. Let me know what you think. Let me know what you use for a reward versus risk, and what you think of the possibility of this ideology actually being incorrect or not as profitable as it should be with market statistics. If you like this kind of video, please give it a like. Hit the thumbs up. Leave a comment. Share your thoughts. Thank you for watching, and until next time.